Are you constantly second-guessing your trades because your indicators keep giving you late signals or false entries? You're not alone, and that's exactly why you need to watch this video. Today, I'm revealing two insanely powerful tools that professional traders use to enter the market with laser precision. No more chasing price, no more falling for traps. These tools are game changers, especially if you're tired of relying on lagging indicators that leave you one step behind. By the end of this video, you'll know exactly how to spot high-probability trade setups before the average trader even sees them coming. So pay close attention, and don't forget to hit that like button and subscribe, because the strategies we cover here are designed to take your trading from frustrated to focused. Now, let's kick things off with one of the most essential tools every trader should have in their arsenal, the Fibonacci Retracement tool. This isn't just another fancy line on your chart. It's a proven method to spot potential pullback zones where price might reverse and continue following the trend. It's all built on the famous Fibonacci sequence, a mathematical pattern that shows up everywhere in nature and, yes, even in the markets. From this sequence, we get powerful retracement levels used by traders across the world. 23.6%, 38.2%, 50%, 61.8%, and 78.6%. But in this video, we're zeroing in on the two most crucial ones. The 50% level, known for showing healthy pullbacks and strong trends, and the 61.8% level, the golden ratio, where price tends to react with surprising accuracy. These two levels can act like magnets for price, especially after big moves. They're not just random percentages, they're zones where smart money often re-enters the market. So, if you've ever struggled to find high-probability entries after a strong impulse move, these Fibonacci zones could be your missing piece. In a moment, I'll show you exactly how to draw them, and more importantly, how to use them in real-world trading situations. Let's jump into a live example so you can see how Fibonacci works in action. In this chart, the market is clearly in an uptrend. We've got a strong bullish push, which we call the impulse leg. After that move, price begins to retrace. Here's how to apply the Fibonacci tool. You start at the low of the impulse and drag it up to the high. As the pullback unfolds, focus on the zone between the 50% and 61.8% levels. This area is known as the golden zone. Why is the golden zone so important? Because this is where price often finds support before continuing higher. It's a sweet spot, not just for retail traders, but also for institutional players looking to rejoin the trend. If you're a more aggressive trader, you could even place a limit order directly within this zone. But keep in mind, while that approach can offer high rewards, it also carries higher risk since there's no confirmation the pullback will stop there. Now let's flip the script and look at a bearish setup using the exact same tool. In this chart, the market is trending downward, a strong bearish impulse followed by a pullback. To apply Fibonacci here, we draw from the high of the move down to the lowest point of the impulse. As price retraces, again, pay close attention to the area between the 50% and 61.8% levels. This is our golden zone for potential short entries. This golden zone now acts as resistance, a level where price often stalls and resumes the downward trend. Just like before, aggressive traders might place a sell limit order directly in the zone. But again, this strategy comes with a trade-off: higher risk in exchange for the chance to catch the move early, before confirmation kicks in. While trading inside the golden zone can be effective, don't make the mistake of relying on it in isolation. Let me show you a quick example. The market is in an uptrend, and we spot a pullback. We draw our Fibonacci from the low to the high and set a buy order inside the golden zone. But instead of bouncing, the market slices right through it, keeps falling, and eventually hits our stop loss. It's a losing trade, and it happens more often than you'd think if you're only using Fibonacci. This is why you need confirmation, something to strengthen the odds that price will actually respect those Fibonacci levels. So, how do you stack the odds in your favor? That's where a method I personally use comes in. I call it the TLLL Method. And it's a simple yet powerful technique that can dramatically improve your entry accuracy. TLLL stands for Trend, Level, and Liquidity Sweep Signal. For a Fibonacci retracement to truly hold, you ideally want all three to align. Let's walk through a real example so you can see exactly how this works in a live market environment. In this chart, the market is trending up. We get a strong impulsive move followed by a pullback. So we apply the Fibonacci retracement from the low to the high. Here's what's interesting. The 50% level aligns perfectly with a previous resistance that is now flipped into support. When a past resistance becomes support, it often attracts buyers. And that gives us the level in our TLLL method. So at this point, we have two solid factors, a bullish trend and a key level aligning with our Fibonacci golden zone. Now we look for the final piece, the liquidity sweep. And there it is, a pin bar candle that briefly dips below the support level, grabs stop losses, then closes back above. That's the trap, the manipulation, and it's a clear sign smart money is stepping in. This completes the TLLL setup. Now it's time to trade it. Entry goes at the close of the pin bar, stop loss just below the sweep's low. Target? The next resistance level above. Watch what happens. Price respects the level and rockets straight to our target. That's the power of combining Fibonacci with the TLLL method. When all three elements align, you're not guessing. You're trading with conviction. In fact, when applied consistently in trending conditions, the TLLL method has shown a win rate of over 75%. It's a no-fluff, high-confluence approach that filters out weak setups and locks in on the trades that actually matter. Now let's apply the TLLL framework to a downtrend. The market is moving lower, forming strong impulses down, followed by shallow pullbacks. At one point, price breaks above a resistance level, which temporarily acts as support. But that move doesn't hold. Instead, price retraces deeper, setting up our Fibonacci play. We draw the Fibonacci from the top of the move down to the lowest point. Take a look. The 50% retracement aligns perfectly with a previous support level that is now flipped into resistance. That alignment is crucial when it gives us a high probability reversal zone. So let's check the TLLL boxes. The trend is clearly bearish. The level is strong, a former support turned resistance. Now we wait for the liquidity sweep, and there it is. A candle with a long upper wick that briefly breaks above the resistance, grabs stop losses, then closes back below. That's your signal. The manipulation is complete, and sellers are likely stepping back in. Liquidity sweeps can show up in different forms: a pin bar, engulfing candle, a doji, or any long wick rejection. The key is the same. Price fakes out traders, then snaps back. With all three TLLL components in place, trend, level, and liquidity, we now have a high-conviction short setup. Here's how you execute it. Enter at the close of the pin bar. Place your stop just above the wick. Your target is the next support level below. As you can see, price respects the setup and drops right into profit. This is the power of combining Fibonacci retracement with the TLLL method. It gives you structure, clarity, and confidence in your trades. Now let's move on to the second indicator that's used widely by seasoned traders, a momentum tool that reveals trend direction and precise entry opportunities with incredible clarity. It's called the MACD, which stands for Moving Average Convergence Divergence. It's actually one of the most practical tools for identifying momentum shifts. The Mark D has three components: the Mark D line, the signal line, and the histogram, all revolving around a central zero line that acts as the Mark D's pulse. And once you understand how these parts interact, you'll start interpreting market momentum in a completely new light. Now, let's unpack it from the ground up, starting with the Mark D line. When the 12 EMA is above the 26 EMA, the Mark D line moves above the zero line. That signals bullish momentum. But when the 12 EMA dips below the 26 EMA, the Mark D line slides under the zero line, revealing a bearish shift. Now let's connect this to strategy. We rely on a three-step formula that consistently produces high probability setups: trend line breakout, Mark D crossover confirmation, and top-down analysis. When these elements align, they create a solid confluence, a structured setup that gives you clarity and confidence. Let's walk through a real-time chart so you can see exactly how this approach comes together on the screen. Take a look at this chart. The market is in a clear downtrend, printing lower highs, all connected by a clean descending trend line. Sellers are clearly in charge until something shifts. Suddenly, price breaks above the trend line. That's our first heads up, a potential trend shift. Sellers might be losing their grip and buyers could be stepping in. But instead of jumping in, we pause. We wait for a second, stronger confirmation. This is where the Mark D steps in. Right around the time of the breakout, we notice the Mark D line crosses above the signal line. A classic bullish crossover. And here's the twist. It happens before the breakout, acting as early momentum confirmation. That tells us buyers are gaining traction beneath the surface. Now we've got two strong signals, a breakout and a bullish Mark D crossover. But to truly lock in the trade, we need one more element. That's where top-down analysis seals the deal. Since we're operating on the 5-minute chart, we zoom out to the 1-hour time frame to get a broader perspective. What do we spot? The market was trending downward but bounced after tapping a demand zone. Now price revisits that zone and gets rejected again. That's a major signal that buyers are holding the line. With this higher time frame confirmation, our setup becomes even more convincing. Here's how we'd play this move. Enter after the breakout candle closes on the 5-minute chart. Your stop loss goes just below the breakout candle to manage risk. Your target? The next resistance level, ideally aiming for at least a 2-to-1 reward to risk ratio. What happens next? Price respects the zone and pushes directly toward the target. The trade plays out beautifully because we combined structure, momentum, and multi-time frame confirmation, stacking the odds in our favor. This trade proves how effective the combination of trend lines and Mark D can be. But what really gives you the edge is the top-down confirmation, lining up your entry with a higher time frame story. It's not just about reacting to price, it's about anticipating it with a clear, structured plan that leverages both momentum and market context. Now that you've seen how these tools align to create powerful setups, imagine stepping into your next trade with this level of clarity. Go ahead and join our Telegram channel and get access to high-quality, expert-curated trade signals every single week, but that's just the beginning. For those who want even more, our VIP signal channel delivers the most premium signals with even higher accuracy and more frequent trade opportunities. Don't settle for average trades. Join a community that wins consistently, so click on the link in the description below to join now and start capitalizing on the market like a pro. If you found value in this breakdown, do me a favor. Hit that like button and subscribe to the channel. Your support helps us to keep sharing these advanced trading insights on YouTube. Still have questions? Drop them in the comments and I'll personally help you out. And stay tuned, I've got another powerful concept coming up in the next video to take your trading even further. Until then, trade smart, stay disciplined, and keep learning.